decent tenants that way. But once again, you're probably more successful with that, the free versions of finding a tenant for mom and pop tenants versus credit tenants.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Hello and welcome to the Gentle Art of Crushing It ROI edition. My name is David Lyons and I'm your host today. In these episodes, we'll be breaking down investing in retail, office, and industrial real estate, helping you, the listener, confidently invest in these assets so you can live life on your terms. Today, I'm really excited to be interviewing Tanh Truong. Tanh has broken into commercial real estate in a really big way, and I think there's going to be a lot of value about what he has to share in his story and how he did that and what he's working on now. I think it's a story that will inspire many of you and really show you what's possible when you think bigger and kind of open yourself up to working with others in commercial real estate. Tanh, welcome to the show.
David, thanks for having me, brother. Appreciate it. Hopefully I can bring some value to your audience here.
Absolutely. I know that you will. So before we delve into kind of what you're up to now, can you talk a little bit about your background and how you got to where you are today, where you started your career, and then how you got to what you're doing today in the commercial real estate space?
Yeah, absolutely. So walking a little bit down memory lane here. So I'm from Cincinnati, Ohio, born and raised here. I went to school here. I actually started my career as a pharmacist. I spent about 6 years in the University of Cincinnati's doctorate program, graduated in 17, and I practiced for about 3 years as a community pharmacist at one of our local community chain pharmacies. Um, so ever since I was in college, I had a knack for finance and investing and whatnot. So I'm always learning through podcasts, books, or articles and whatnot. So that kind of led me down a rabbit hole of learning about the stock market in general, learning about how to evaluate stocks, how to invest in value-added stocks, right? Like that led me to Buffett, Munger, Carl Icahn, Peter Thiel, those the pioneers of the value investing in general. So, and my curiosity kind of led me to real estate, and through the same tenacity, I learned a lot about residential real estate. And in 2018, I partnered up, joined forces with another classmate of mine, and we started acquiring a handful of residential properties as rentals. And through the years, we kind of split up and amicably and kind of went our own ways, and that's how I started transitioning into commercial from that point in time.
Sounds good. And so what drew you to commercial real estate from residential?
I think I always had an interest in commercial, primarily probably because it was also always so elusive. It was one of those asset classes that you couldn't really find enough information on, and all the information that you actually find online were through YouTube videos or articles that really gave you the rudimentary understanding of what commercial truly is. And you'll probably get more so of apartments and multifamily versus your traditional non-residential commercial asset classes like office, retail, warehouses, things like that. So my interest was that I wanted to learn so much more about it, but I couldn't, right? And so I started networking firstly in my area in Cincinnati here, and I found a mentor who actually has been doing it for well over a decade. I think he's actually coming close to 15 years in his career now in commercial. So reach out to him, and through tenacity, through persistence, I was able to get in front of him, kind of learn a little bit of what he was doing, and started implementing that into my investment strategy. So I would have to attribute a lot of my successes from him.
That sounds great. And I want to dive a little bit deeper there because I feel like that's a really golden nugget that I think our audience could learn from. because I think our audience would think to themselves, if I had a mentor, if I had a mentor who's been doing commercial real estate for 10 years and could learn from them, ask them questions, get guidance from them, potentially partner with them, right? Of course I could make it in commercial real estate, but it's like, well, how do I find the mentor? Where is the mentor, right? So like, where did you find him? Was it at a networking event? And, what were the sequence of interactions following that first, meeting that kind of led to that mentorship that you have?
So initially, I met him through an investor meetup. So, Joe Fairless, one of the bigger multifamily guys in the space, he hosted a Cincinnati get together for real estate investors. And I met Ash Patel, who's my mentor, through that meetup. And the first time I met him, it was just, generic, what's your story, and kind of getting to know each other and whatnot. But I engaged Ash when he was on several podcasts, and he shared his story, and that's when I got to learn a little bit more about him, and where we shared a lot of our connections, similarities of growing up and whatnot. And I was reaching out to him consistently and persistently, right? And he was always super busy. As you know, a lot of us in the business world, in the real estate world, are super busy. And I reached out so many times and with so many failures that luckily I almost gave up, but luckily I didn't. So I pretty much just, to be not to be weird or anything, but I Facebook stalked him. I looked at his social media, like what are his interests, what does he like to do, and I once again, week after week, I hit him up on Facebook Messenger, be like, hey, I just need an hour of your time. I don't care where you want to meet. Can I treat you to dinner? I'll take your wife out. I'll take your kids out. Whatever restaurant you want. I just need an hour of your time. It's just to learn, right? And once again, week after week, it was just, no, man, I'm busy. I can't do it. Let's shoot for next week. Same thing. And then eventually, I was just like, look, I know you're super busy. I only need 30 minutes of your time. I don't care where you are at the moment. You could be 8 hours away. I'll drive there. Hey, I just need to talk to you for 30 minutes, phone call, virtual, whatever, but I'd rather be in person. So wherever you are, I'll come through, take 30 minutes of your time. I'm out of your hair after that. And I think the persistence is actually what got to him. And through that persistence, he was like, hey, man, I'm at my lake house. More than welcome to come. And so I did. I was like, on the drop of a dime, I took the address, typed it in, an hour 15, hour half out. So I drove there, hung out with them, and that 30 minutes there actually turned into like 8 hours. I actually hung out with him the whole day and stayed the night and whatnot at his lake house. So I was honestly floored that he said yes, but through the graciousness that he showed me with his time, not even the 30 minutes that I asked, but throughout that whole evening, it wasn't more, I never really focused on myself. I never asked him like, hey, how could you help me? Like, how could this interaction benefit me in any way? So I always focus on the other party. At that moment in time, I was focused on, what his problems were, what he's working on. How could I help him overcome some of his obstacles? Like, what are your goals, And if I could somehow add some type of value to him, I think that would have been, in my eyes, a repayment of the debt that he gave me for that evening. So I guess the theme of that is, how much value can you provide to someone, whether or not it be a mentor, so that the relationship can grow from there without you asking for anything in return. And that was probably the biggest key piece of him being so open with helping me progressively thereafter and eventually becoming partners.
That's awesome. I love that story. So there's 2 or 3 things I want to highlight from there. The first thing is, you mentioned persistence a lot and how much you were following up. And I think it's such a big thing. And I could even learn from that as well, because it's like, sometimes you reach out to somebody and you don't want to be annoying, right? So I'm like, they're busy. I don't want to keep annoying them, right? But it's like, if you do that politely, respectfully, and just showing your interest and in a way that's like, you're, willing to bend to their terms, meet them at their place, right? Is eventually something's going to budge. It's like, all right, if this guy messaged me 10 times, 15 times, and he's been respectful and he's willing to drive here. It's like, how can somebody continuously say no to that, right? And you just kind of weighed it up and saw what could happen from that, and it sounds like it evolved fantastically in your favor and for a win-win for both of you. And then the second part was focusing on the other person and how you provide value to them. Like, you're not there like, hey, how can you help me buy my first building? It sounds like you're focused on how can I help you and whatever it is you're doing in any way. So I mean, like those two things, if you apply those, it seems like that's a pretty sure way to find a mentor. So thanks for that.
Absolutely.
Perfect. So now you have this mentor. So can you talk about your first purchase in commercial real estate, be that with a partner or yourself? What was your first deal like, and how did that come to be?
Yeah, so I'll with in the commercial space. So I'll kind of rewind with how I could have helped my mentor, Ash. And I think his plateau was that he was unable to find additional deals to grow himself. So, he was always focused on very specific properties and in a with specific criterias in terms of, price points. I think he was at the point where he wanted to buy everything himself and not involve any other investors and whatnot. So I learned the criteria that he was looking for, but we're always helping each other out, like pushing each other's boundaries. Like, why are you thinking? Why is your mindset this way? Why can't we change it to this, right? But so throughout those conversations and whatnot, I learned that he's looking to grow, but he's at this plateau. So I thought, what if I helped you find deals? What if I was doing a little bit of bird dogging for you? Like, if I find deals, would that help you? Like, would that help you overcome your obstacle? Would that get you to the next level that you're looking for? So after I spent a little bit more time with Ash, he was able to show me kind of how he looks for deals, teaching me kind of the rudimentary stuff, but with his eyes. So I was looking through the lenses of an experienced operator, an experienced commercial real estate investor. And through learning that, I was able to find deals for him. So my first deal was utilizing his techniques and his eyes to find a deal. And my first deal was it was a $5 million strip mall. I honestly wasn't even expecting to be a partner in the deal. I was just helping a friend. I was helping a friend, a mentor, a brother, whatever. And so we found the deal, and it turned out to pencil out very well. And I was just like, hey, man, this looks like a pretty good deal. And from my perspective, I thought it was a good deal because it was pretty much in our backyard. It's about 30 minutes from where I live. I'm on the west side of Cincinnati. This is 30 minutes north of Cincinnati. And I knew the area very well because I frequently traveled there. It's on a street that's heavily trafficked, higher income households, and it looked nice. Like, there was nothing wrong with it. So I pointed it out to him, like, hey, and at this point, I didn't know anything about underwriting, so I couldn't tell you what the returns were, but a lot of those things kind of stood out to me that it looked like a good deal. So I pretty much sent that to him, and through our conversations, we kind of penciled in a partnership structure where I would get a part of the deal. So in real estate, if you find deals, you can structure it in so many ways. You could do an acquisition fee, or you can do a partnership structure, or a hybrid. Anything with your imagination is workable in a real estate deal. So I decided to just take a partnership of the deal and help manage the property so that I can learn firsthand about the property and how to invest in commercial real estate in general. So then through that, it was kind of like a course, learning firsthand commercial real estate while getting paid for it. It's super cool. Yeah, so that's my first commercial deal. Elaborate a little bit more on that.
Yeah, I'm curious to know. So, it's awesome that you found how you could help him and found that deal essentially, right? Can you talk a little bit about how you found that deal and maybe just in general how you approach finding deals? Because that's like that's another big piece, right? And the commercial real estate world is how do you find good deals, right? And a lot of people think, look on LoopNet, maybe Crexy, these other online listing sources, right? And I think there can be good deals there. I'm curious to know if this was listed online, if you found it directly through a broker, or how that came about.
Yeah, so if you're looking at Crexy and LoopNet, I think you can still find deals, but the idea
Yeah.
behind LoopNet and Crexy is that there's so many eyes on it already. It's national. Everybody sees it for commercial, that is. But Osh teaches us that when we're looking for deals, we want to look for deals where no one else is looking, right? Where there's less competition, things like that. So this one I actually found on a broker's website that was, I don't want to say mismarketed, but undermarketed. It wasn't on LoopNet, it wasn't on Crexy, it wasn't on City Feet, any of these larger websites where a lot of eyes are on it. And so it was on the website, and I just looked at it, kind of briefly ran down the executive summary, things like that, reached out to the broker, got more information. So the process is actually a lot more rigorous than it sounds. Like if you're going through hundreds of broker websites, it takes a lot of skimming and analyzing in order to find the one deal. So it's not all sunshine and rainbows. It's actually a lot of work. But yeah, so that's how I
Yeah.
found that deal. There are other ways to look for deals too. Aside from resident, you can have broker websites, but you can also look in residential broker websites that actually have commercial listings. Some of those, they're a lot of times they're mismarketed. This one, in my favor, was just undermarketed. So
Fantastic. So you're looking in other places that people aren't looking, namely, kind of smaller boutique brokerage websites where there's not a lot of eyeballs.
correct. Yeah.
Correct. Could you walk through in a little more detail this deal to the extent you're comfortable, and maybe actually could you touch on kind of what criteria are you assessing when you're looking at a deal? What are maybe the top three things, as a first pass that you're looking for to determine, hey, is this something I should pursue, maybe make an offer on, or get more information on? So top three criteria in assessing a deal.
Sure. So and this was my first find. So as
Yeah.
as I look at more deals, I become a little bit more comfortable with what I know and what I'm looking for, right? But
Mhm.
as far as criteria goes, I look for the locations. Number one, right?
Yeah.
You can't fix location. So I look at the household income to see if the area is has a population that's actually, you know, at the poverty level, or they're in the median level, or are they really high net worth. Generally, if they're in the middle or lower tier of middle, that's that should be good. So on top of that, I look for other factors with the building in general. So if it's in a retail corridor that services that population, it should be good
Mhm.
to go. Signalized traffic is fantastic. Why?
Mhm.
Because if cars are stopping, they'll see the center, and they're more in tune to turn into the center rather than not. And I also look for job growth. So a lot more on the population itself. So we're looking at demographics from household income, job growth, and then location. So in terms of job growth, I look for stagnation or a positive job growth. If it's negative, I tend to stay away from those because people are moving away from that area, or the there's no development, or there's just no activity there. So I
Mhm.
typically try to avoid those.
Perfect. So sounds like the first things are location, household income, and job growth.
Yes, main
Right.
three that I look
Okay.
for.
And then when you're trying to assess, what is this property worth, and how much should I offer for this property? What's the approach there when you start looking at, rents, purchase price, square footage? How do you approach that? Determine what a property's worth and what you think it would be worth to you.
So there's multiple ways of doing it. If you have access to one of the bigger services like CoStar, Crexy, Reonomy, things like that, you can kind of get a lot of data on the area of what things are selling for. And obviously you have to pay for it, right? The second way is you can kind of look at broker opinions. If you have a good relationship with brokers in the area, they'll let you know what properties are selling for, and that comes from your relationship with them. Or three, you can kind of do your own analysis. You can, look at the free version of Crexy or LoopNet and just look at what's going on for sale. Okay, this one's listed as a 5 cap, 6 cap. So maybe this property being a mile away is probably in that same class. I also look at price per square foot, and that's, it's what are properties selling for on a price per square foot level, cap rate, and is this property worth that price per square foot that they're advertised at? And also, you have to be cognizant of what the replacement cost is. So different areas have different replacement costs. You could be in California where it costs $200-300 a foot to build brand new, whereas in the Midwest, Cincinnati here, for example, it's probably like 100, 150, 200 for luxury, right? So being cognizant of some of those KPIs or metrics is important.
Okay, got it. So to summarize that, you mentioned cap rate, which essentially is an income-based approach to valuing a property, right? So how much income is it producing? And then cap rate is kind of the inverse of a multiple on that income. So a 5 cap means it's selling at 20 times the income it generates. And then you also mentioned price per square foot. So in presumably in reference to other buildings that sold. So if another building down the street that's, similar in style, in condition, and type of building, and that sold for $200 a square foot, and you can buy this for $150. Well, that's a good deal. All other things being equal.
Potentially, yes. Yeah.
Gotcha. Okay, cool. That's great. And then, so what's the strategy when you buy a building like this? Presumably, well, what's the strategy? And in general, there's a couple big bucket approaches to investing in real estate where you can kind of buy something that's stabilized or maybe something that you can add value to. It sounds like you're more in the value add space. And so how do you add a value to a property like this? And for this specific property, what did you guys see as potential in it?
Sure. So yes, we are value added investing. I look for value add versus your stabilized asset. And the reason being, your stabilized assets generally have lower yields. If you're able to add value to a property, you can force appreciate the value of it. And I can go into numbers if you like afterwards and whatnot, but I'll answer your question on how we add value. So for this particular one, it was a roughly 100,000 square feet strip mall, and it was purchased for roughly $5 million. And at the time of purchase, it was 80% occupied, so 20% vacant. And so the ways we added value are initially was leasing up the spaces. Some of the tenants were under market on their rents and had different lease structures, right? So what we do is we just after purchase, after transitions, we have a conversation with the tenants to bring those leases up to market. And if there are tenants that have leases that are expiring soon, we reconfigure their leases. So let's say they have a gross lease or a modified gross lease. You can configure that to a triple net lease or double net or a single net lease. And that will actually add more value to your building. And on top of that, the parking lot on this particular building was massive, and we were able to create an outlot and sell the outlot, and it's pretty much a development project in that piece. That was sold for roughly $500,000. So those are the ways that we've added value to this particular building. And additionally, I will say that I also look at ways to optimize your tenant profile. So you don't want a center with 2 barbers or 2 nail salons or a doctor's office in one and then a bar right next to it. It's just, there's no synchrony there. You want synchrony within your tenants. Your job as a landlord is to pretty much their partner. You're there to help them succeed in their business, right? So on top of that, um, you want to make sure that the spaces are utilized for their best use. So if in this example, we had a tenant who was on a month-to-month lease that was a small mom and pop furniture store, which was occupying the largest portion of the space, roughly 30,000 square feet. And we had a conversation with them like, we will need to get you're not at market rent, you're well below market rent. So market rent's here, you're here. We can gradually increase you. That's one option. Or two, we can downsize you to one of our other vacant spaces. Or three is, help you relocate into another spot altogether. So eventually they chose that, they were gonna not take any of those options, and they wanted to just cut down and stop business. So we got another operator in there who's a national credit tenant. So going from a mom and pop tenant to a credit tenant, the value of your building just went through the roof, right? Not even assessing for the NOI changes, but just having that powerful tenant in there adds a lot of value.
Yeah, that's fantastic. So you just unleashed a lot of knowledge and a lot of value that I want to make sure we unpack. So in terms of how you add value to a property, you mentioned one is just increasing the rents. That's maybe the most straightforward way to kind of understand, right? It's currently renting for $10 a square foot. You can increase the rents to 12. Second, you mentioned was reconfiguring leases, right? So if it's a gross lease, converting that to triple net. So what that means for anybody who's still new into these terms is a gross lease, the tenant is paying, sorry, the landlord is paying for the taxes, insurance, and maintenance, or at least for maybe most or all of those. And for a triple net, generally the tenant is now paying for those. So it's a way to reduce expenses for the landlord, essentially. It also makes it a little more passive potentially for the landlord, depending on the lease structure. Then you mentioned an out parcel. And so it sounds like there was a piece of the parking lot that you guys kind of separated and sold. It sounds like, is that what you guys did there?
Yes, yes. So that involves
Gotcha.
a lot of moving parts, a lot of a lot of time as well. So,
Yeah.
it's one of those where you have to be in conversation with the city, the municipality that your property is in, getting, surveyors, attorneys, civil engineers, all of those people involved in order to kind of plan out what is going to happen with that piece of land. So then after that, there's a lot of title work that goes into it as well. So after that, you're able to package it up and sell it off to another party who could or could not have a plan for it. But in this scenario, we sold it to another credit tenant, if you will, to occupy the space. So once again, having a credit tenant in that outlot creates a lot more traffic and a lot more visibility to the center, and thereby value.
Sure. So how is that process of kind of, parceling off this out parcel? Would you say that it's like, in terms of probability of succeeding and doing that, like, is it very dependent on the circumstance, the configuration of the land? Is it just something where you got to really understand your city? And I guess essentially, how were you guys confident that you would be able to do this? Or maybe you weren't and you kind of just tried it and it worked.
Honestly, we weren't. So,
Yeah.
the main key to getting something like this approved is knowing the jurisdiction that you're in, knowing the
Mhm.
municipalities, knowing whether or not the city council or the planning committee is unified or separated. If you're in a
Mhm.
municipality where they're separated and always butting heads or arguing with each other, 9 times out of 10, you're not going to get anything done. And that's probably
Yeah.
why that area's never seen any type of development. Now, if they're pretty unified and they're on the same page, more than likely you'll be able to get something done. So if they're reasonable, if they're happy, if they're things like that, if you see positive signs within the community, they are you have a good chance of getting something like that approved. Once again, it's a relationship business. So if you can get them to like you in some manner, show up to city meetings, things like that, you can work with them to getting something approved. So that's probably your number one factor. But as far as configuration goes, there's always different configurations, right? That depends on your other team members that you're putting onto the project, your attorneys, civil engineers, surveyors, etc. But things like that can always be changed depending upon the city. So
Sure.
you definitely want to know your city first.
Gotcha. That's an important one. It sounds like that's the main thing, and you can kind of put together the other pieces if that piece works. All right, that's awesome. And then the other piece in terms of adding value to a property that you mentioned is getting a kind of tenant mix broadly, but specifically in this property was getting a credit tenant. And so, can you explain when you say credit tenant, what does that mean? And why is a property, where all other things are equal, besides, in terms of rent, square footage, and one's a credit tenant and one's not, one's maybe a mom and pop, why is the credit tenant one more valuable?
Sure. So when you're looking at two different tenants, right? Let's say one tenant is McDonald's. Let's say the other tenant is Bob's Burgers, your local Bob's Burgers. Even though they make great burgers, who would you rather be more comfortable owning a business? Bob's Burgers or McDonald's? I think a lot of people would say McDonald's. Why? Because they have a long track record of being in business and they're less prone to fail, right? Whereas Bob's Burgers is a smaller tenant. They probably don't have as much reserves, most likely won't have as much reserves as McDonald's, and they are more prone to failing with different market cycles or different economic factors. So a credit tenant is essentially one who has high credit, someone has who you're a lot more comfortable with being in a space rather than not. So what do investors like? They like stability, right? When
Mm-hmm.
you're investing in something, if it's stable, you're going to pay a higher price for it because there's less risk, right? So in this, and I hope that answers the question of the credit tenant versus not. And I think that's why when we're looking at, I'll touch on configuring leases a little bit too, because if you're uh, if you're at a modified gross lease or a gross lease and you transition that to a triple net lease, the triple net lease is more favorable even if your base rent is lower. And I'll give you an example. Let's say the gross lease for John is $10 a foot. But then you can reconfigure the lease in a triple net form, but it's $5 on a base rent, but then $5 in triple net for taxes, insurance, and CAM or common area maintenance. The $5 base rent plus the five is a lot more enticing because there's a lot of stability for the operator. They, even though they're getting that lower base rent, all their expenses are offset to the tenant because let's say we're in a period like we are now of high inflation where things are just super expensive, all those expenses gets passed on to the tenant and get reimbursed to you even though you paid for it. So, the expenses are offset to the tenant in the triple net lease. So if those variable costs are changing in the upward trajectory, those costs gets passed off to the tenant. Your NOI and value of the building is still stable. If
Mm-hmm.
you are in a gross lease or a modified gross lease, and we're in the same type of environment where inflation is running rampant, those costs are
Mm-hmm.
onto you. So even though you're getting $10 in gross rents, then your expenses could jump up 100% or 50%, and those
Mm-hmm.
expenses become yours. Now your NOI drops. That's why your triple net leases are more valuable to the center as well as
Mm-hmm.
the value of the building in general.
Sure. So I know I asked you two questions. So to recap, the first question was in terms of what is a credit tenant? And you essentially said it's somebody who's has good credit. They may be publicly traded. They may have a credit rating from a, S&P or something like that. But essentially the value there is the surety for you as the landlord of collecting their payment, knowing that their rent's, going to come in every month, as opposed to, the Bob's Burgers example where, maybe they have some sort of family breakdown or some issue that causes them to go to business in a couple of years.
Correct.
And then your the second kind of question or point you were making was in terms of the lease configuration and the value of a triple net lease also has a similar effect in that it's more stable for the landlord because you're not dealing with those variability of expenses that you're having to pay because the tenant is paying for those.
Correct.
Okay. So that's awesome. So now this leads to one last question when it comes to kind of tenants and credit tenants and quality of tenants, right? So you guys essentially, I won't say, you kicked out this furniture store, but you essentially force them to up the ante and either pay market rent or kind of get out. And it sounds like you were willing to work with them and being respectful, right? But if they weren't paying market rent, something had to give. So they decided to leave. And so, you guys obviously were confident in your ability to rent the space because losing a tenant, is or could be seen as a risky situation, but obviously you guys knew what you were doing. So that leads to my question, which is how do you go about placing a tenant in this property and attracting a credit tenant? Because it sounds like, everybody would want a credit tenant. How do you go about getting them? Were you working with a leasing broker? Were you, outreaching to these tenants directly and how did that work?
Yeah, so that's getting a credit tenant. How to get a credit tenant is pretty much your $1 million question.
Yeah.
So I'll kind of go into a little bit of tips and tricks too, and I'll follow up with, or I'll end with how to get the tenant. So initially, you can actually lease out and rent the spaces yourself, whether it be industrial or retail or office space. You utilize all the free services that you can, right? You can place an ad on LoopNet. They have different packages for various ads or various types of ads. You can put a listing on Crexy. The listing on Crexy, however, will require a listing agent. So not necessarily free yet. So if you're going to the paid route, that will have to be. But I mean, if you're enlisting the help of a broker, they're going to do that for you anyways, right? So let me back up and go towards the free stuff. So Craigslist, thousands, millions of eyes on Craigslist. Facebook Marketplace, same thing. All those three, free. Signs, get for leasing signs in your space, make it absolutely huge and visible so that traffic is there and they're able to see it, with your number or things like that. So, and on top of that, you can also cold call, do some door knocking, right? If you're in the area and you notice that there's not a smoke shop or a vape shop or whatever those are, or there's not a dentist within 50 miles, that might be a good person to get in your center, right? So just call the local dentist. Hey, are you looking to expand? Are you looking for new space? What are you paying at currently? What if we gave you an enticing offer on leasing out some space? Or, so when it comes to cold calling, I kind of do two things. I'll look for a radius of businesses in the area who are looking to, and just cold calling them to see if they would want to expand or they want new space, or if they're interested in downsizing or whatever, depending upon the sizes they're occupying now and the space that you have to offer. So I'll do that. And if door knocking is available, if you're in the area and you can go to a certain business, like, hey, how do I get your shop into my center? Like, you're just pretty much talking to the people at the shops and whatnot. So I touched on Craigslist, Facebook Marketplace. Oh, the other thing, Facebook groups. So if you're in a certain area, most often you're going to find a Facebook group in that area of just all the residents, right? Post the same thing in there, like, hey, I have this space for lease at this address. I'm looking for these type of tenants maybe. But if you have anybody who you think is interested, or if you're interested, please reach out. Happy to pay referral fees if they end up signing a lease with us. And so those are all the free ways of getting a tenant in there. And more often than not, you're probably going to get non-credit tenants. But depending upon the business and the area and what's suitable for your center or your space, that could be a win-win. Now, if you want a credit tenant, you have to go a little bit outside of the box here. So the first and most easy way is obviously signing on a leasing agent with a big company, CBRE. We had Cushman and Wakefield. So what is it? Marcus and Millichap, the big companies. They have a far larger reach and they have a bigger network. So that's why they're able to get in credit tenants. So in our circumstance, we enlisted the help of a broker to get a national tenant in there. Mind you, the fees could be pretty large. It could, a lot of times you're looking at a month's worth of lease, so a month rent as commission to the broker, or 6% of the base lease. So if your lease is 2 years and it's, let's say $10,000 annually for 2 years, that's $20,000. So it'll be 6% of $20,000, which is, what is that, $1,200? So that's more expensive, but they get all the marketing out of the way, and obviously they have a larger network. So that's one way. And then two, and this is more of a free way of doing things. Stalk them on LinkedIn. So you can search for credit tenants on LinkedIn, finding the head director of real estate or head director of leasing or director of operations, things like that. And I'm not saying it's you have a 100% success rate, but it has worked. So if you want to reach out to the director of McDonald's or something like that, they might be a little bit harder to get in touch with, because who knows if they even check their LinkedIn, right? But you can reach out to them that way. I'm like, hey, I had this space perfect for someone your size, because I know you operate in this particular size space. I have a space. I'm willing to talk terms with you. Let me know if you're interested. Things like that. And sometimes you can get decent tenants that way. But once again, you're probably more successful with that, the free versions of finding a tenant for mom and pop tenants versus credit tenants. Can you hear me?
I can hear you.
Okay,
yeah.
I got you now.
Can you hear me now? Yeah, sorry, I had muted my mic, so we'll edit that out. But I'll just take a minute to reset it and then respond. Okay, so it sounds like there's a lot of creative free ways to find tenants. You can knock on doors of existing businesses. You can post in Facebook groups for local areas. You can cold call. You can, do direct outreach via LinkedIn to companies with their, directors of leasing or whatever it is. And then there's kind of the other way, which is working with leasing agents who maybe already have that existing network. It's easier. It's going to cost you a little more, but maybe gives you a little more reach or ability to attract maybe higher quality tenants who aren't necessarily looking for their places on say Craigslist or Facebook.
Correct. Yeah.
Yeah. Awesome. Well, there's been a ton of value that you've dropped here today, Ton. And I would say that if somebody was looking to get into commercial real estate and there's like, what one podcast should I listen to? I think this would be it. There's a lot in terms of, finding a mentor, putting together a deal, finding deals, and then kind of managing and adding value to deals. So super stoked that we're able to get you on here today and share all that, you've done and all that you're doing. If our listeners want to get in touch with you, what's the best way to reach you?
I'm pretty active on social media. You can search me on Facebook. I might be the only one or two there. On Instagram, my handle is pro_Tan, TANH. You can find me on LinkedIn. I'm pretty, once again, active on those, and I'm pretty readily available to answer any questions.
Awesome. Well, thanks so much for coming on. It's been awesome hearing about your story, and it's really an inspiration. For our listeners, Ton's contact information and social media links will be included in the show notes, so definitely feel free to check those out. And with that, it's been real, and that's it for today, folks. Signing off.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.